As of Saturday, July 25, 2026, the stock market is closed for the weekend. At the close of the most recent trading session on Friday, July 24, 2026, Nokia Corporation, trading under the ticker symbol NOK on the New York Stock Exchange, finished at $9.10 per share. The stock experienced significant volatility following its second quarter earnings release, opening at $9.58 before trading between a session low of $9 and a high of $9.69 on massive trading volume exceeding 119 million shares. When retail investors scan their daily watch lists across popular platforms, they often lump Nokia into the category of forgotten legacy telecom equipment providers. The consensus narrative suggests that Nokia is bound to slow growth due to lukewarm telecom carrier spending on fifth-generation wireless networks. However, when you look closely at the underlying financial data, a sharp divide opens up between market sentiment and operating fundamentals. While traditional mobile network upgrades have indeed moderated across North America and Europe, Nokia recorded a staggering 105% surge in artificial intelligence and cloud order intake during the second quarter, pulling in €2.8 billion in new bookings. What looks on the surface like a sluggish hardware maker is actually turning into a key backbone provider for optical networking and high-density data center interconnects. The gap between investor expectation and reality creates unique dynamics for traders using an individual brokerage account. The average market participant assumes that the excitement in tech is strictly confined to high-valuation mega-cap names like Nvidia stock, Apple stock, or high-beta volatility plays like Tesla stock. Because of that belief, value-focused network infrastructure companies often trade at compressed earnings multiples despite securing critical infrastructure contracts. To understand why Nokia stock moved so aggressively in recent trading sessions, we have to look closely at the second quarter numbers delivered on July 23, 2026. Nokia generated net sales of €4.815 billion, representing an 8% year-over-year increase. Comparable operating profit came in at €434 million with a 9% operating margin. Management updated its full-year comparable operating profit guidance range to between €2.1 billion and €2.6 billion, primarily reflecting technical accounting adjustments from discontinued operations while maintaining its core operational baseline. Market reactions were mixed as short-term traders focused heavily on uneven capital expenditure cycles among global telecom operators. Yet institutional accounts utilizing Interactive Brokers trading platforms and Fidelity Wealth Management services have been closely watching Nokia's margin trajectory and order backlog. Over half of the recent €2.8 billion AI and cloud order intake is scheduled to convert directly into recognized revenue over the next 12 months. This creates a multi-quarter tailwind that many passive investment strategies fail to price in immediately. If you analyze trading flows across self-investing channels, including retail traders executing orders via the Robinhood app or utilizing SoFi active investing features, you notice a growing curiosity about non-US technology suppliers that provide physical hardware to hyperscalers. When investors manage their holdings through Robinhood stock trading or set up automated asset allocation through Schwab Intelligent Portfolios, they often seek exposure to the AI supply chain without paying 50 times earnings. If you are currently evaluating your portfolio allocation or looking for investment help, drop a comment below. Comment below how many shares of Nokia you currently hold in your portfolio, or tell me if you believe optical networking will overtake traditional wireless equipment as Nokia's main revenue driver over the next 3 years. Hearing how different investors approach these cyclical turns helps everyone gauge market sentiment. To understand where Nokia stock goes next, it helps to examine how the current environment compares to historical trading patterns.
For decades, Nokia was household name because of consumer mobile handsets. That era ended over a decade ago when the company pivoted entirely toward enterprise networking, optical hardware, and telecommunication infrastructure. Today, Nokia operates through four core business segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. Network infrastructure focuses on fixed network solutions, IP routing, subsea cables, and optical networking. This specific division is benefiting directly from cloud providers expanding data center capacity. Mobile Networks provides radio access network equipment to telecom carriers globally, representing the most cyclical part of the business model. Cloud and Network Services delivers software and platform solutions, while Nokia Technologies manages an extensive global patent portfolio generated by decades of research and development. Patent licensing remains Nokia's most profitable engines. The company regularly signs long-term cross-licensing agreements with major smartphone vendors, automotive manufacturers, and consumer electronics brands. These licensing agreements generate high-margin cash flows that support the company's balance sheet, fund ongoing research, and cover dividend distributions. For the financial year, the board resolved to distribute a dividend of €0.04 per share with a record date of July 28, 2026, and payment scheduled for August 6, 2026. This ongoing capital return program appeals to income-focused investors using Fidelity mutual funds, Fidelity IRAs, or dividend-focused portfolios within SoFi Invest. When analyzing the daily price action and technical structure of Nokia stock, institutional volume patterns tell an interesting story. During periods of broader market consolidation, money frequently rotates away from expensive growth equities towards value names with durable cash flow. Investors using Interactive Brokers platform tools or tracking market depth through Fidelity trading platform noticed sustained institutional block trades whenever Nokia approached cyclical support zones. Interactive Brokers fees and execution tools make it easy for systematic funds to accumulate shares during pullbacks without driving up the ask price instantly. Similarly, traders leveraging Fidelity brokerage accounts or Robinhood investments have noted that Nokia's low share price makes it an accessible option for dollar-cost averaging or utilizing Robinhood fractional shares to build positions over time. The reality of Nokia's business model is far more nuanced than simple headlines suggest. While traditional telecom carriers have slowed down their 5G rollouts after heavy initial capital expenditures, enterprise demand for optical routing and data center interconnects is picking up the slack. Modern data centers running complex machine learning workloads require massive bandwidth and extremely low latency between server racks and external networks. Nokia's optical networking gear and routing chips directly address this bottleneck. Analyst upgrades over recent weeks have highlighted this exact shift. Major global investment firms have revised their target prices upward, noting that growth in cloud and network order intake offers a clear path towards margin expansion in late 2026 and early 2027. When managing online investing activities across platforms like SoFi, Robinhood, Fidelity, or Interactive Brokers, evaluating valuation metrics relative to industry peers is essential. Compare Nokia to other infrastructure providers, and you find a business trading at a discount to its long-term earnings potential. Investors looking through investing sites or seeking individual brokerage guidance often compare Nokia to its Scandinavian rival, Ericsson, or U.S. networking giant, Cisco. While Cisco commands a premium valuation due to its enterprise market dominance, Nokia's expanding footprint in AI network fabrics and optical routing provides a unique risk-reward profile for investors focused on online investment opportunities. Looking forward toward the second half of 2026 and into 2027, several catalysts could bridge the gap between market expectations and operational reality. First, the conversion of Nokia's €2.8 billion AI and cloud order backlog into recognized revenue will serve as a direct test of execution capability. If revenue conversion stays on schedule, operating margins should widen, proving to skeptical analysts that product mix is shifting towards higher margin software and optical equipment. Second, any stabilization or modest recovery in North American and Indian telecom capital expenditures would provide an upside surprise for the mobile networks division. Third, continued expansion of patent licensing deals into new verticals such as Internet of Things devices and smart vehicles will continue to pump steady cash into the business. On the flip side, risks must be carefully considered. Global macroeconomic pressures, persistent high interest rates, or further delays in carrier network upgrades could weigh on near-term revenue growth. If hyperscalers temporarily slow down their data center expansion plans, Nokia's optical network segment could face delayed order fulfillment. Investors using intelligent portfolio tools, SoFi robo-advisor systems, or self-investing strategies should account for these cyclical fluctuations when structuring their positions. Diversification across asset classes, including broad exposure to Fidelity ETFs or SoFi ETFs, remains a practical approach to managing risk while maintaining exposure to single stock upside.